everyone. Happy holiday seasons. Amanda Fabiano here on episode 2 of Hashing for the Holidays, a Bitcoin Magazine Limited Series podcast. Today we have with us 3 very fun North American-based companies. Gentlemen, can we do a quick intro? Todd, do you want to start?
Yeah, sure thing. Todd Garland, Great American Mining, and we mine on oil fields using flare gas.
Awesome. Jason?
Jason Less, CEO of Riot Blockchain. Riot Blockchain, NASDAQ traded Bitcoin mining company. We're the owners and operators of Whinstone US, facility with up to 750 megawatt capacity in Rockdale, Texas.
Amazing. And Ben, I can tell by your background, but just in case someone isn't watching on video, where are you?
I am Ben Gagnon. I'm the Chief Mine Officer for Bitfarms. We're a publicly traded Bitcoin mining company traded on both NASDAQ and the Toronto Stock Exchange. And we operate a number of different mining facilities in Quebec, Canada, the United States, and are also developing new facilities in Paraguay and Argentina.
Incredible. So lots of different experience on this conversation, which I think we can draw into really what we want to focus on, which is the growth in North America of hashrate, right? So this has been definitely a trend this year that we've seen, especially after the Chinese exodus. We do a lot of research at Galaxy on Bitcoin mining, and we expect that over 14,000 Bitcoins have been mined in Q3 by publicly traded companies, which represents about 17%, right, of the total Bitcoin rewards. And the rise of public mining companies also allow us insight into just the overall industry, something that was super, super difficult before. But with that, we're also seeing a lot of companies start to go public via SPAC or IPO. Generally, do we think the market is saturated for public miners? Hot take there, if you think so.
We've got a huge demand here for more and more companies to become publicly traded. I mean, the big drive here is that we're such a capitally intensive industry that if you can't raise capital quickly, flexibly, and cost effectively, you really just can't compete in this industry long term. And I think one of the greatest advantages as a publicly traded company is that ability to raise capital, both through capital markets and through traditional financing entities. Being publicly traded gives a lot of credibility, a lot of transparency to an industry that previously didn't have any. So I think this is a big positive thing. I think this is a development that shows the evolution of the industry over time. We've gone through several stages over the last 11 years of Bitcoin mining, where we had a transition into hobby miners to entrepreneurs to kind of cloud computing companies who, really it was difficult to manage any sort of investment through those because it was hard to verify what's going on. I think the public companies is the next evolution of that. And I think we're really just getting started on that. I think over time, there's just going to be more and more publicly traded companies, and there's going to be every incentive, if you are a private miner, to become a public one.
Yeah, I think Ben's spot on. The key point being this is a capital intensive business. You need mechanisms, avenues to raising capital to remain as competitive as possible. And public markets, particularly in the United States, offer that. There are an enormously, I don't even know the number of public companies today compared to a year ago is so much different. There's so many more companies, and it's changing on really a weekly basis now because they're all seeing this opportunity, and it's becoming a necessity to compete. And I think what we're going to see more so going forward, right now we see like lots of big mining stories going public. These companies have existing large operations, or they have plans to have large operations as a result of their public listing, which is important to get investors buying into your future mission. But what I think we'll start to see is smaller and smaller miners start to go public, not necessarily because they're trying to be the biggest miner of the world. They just try to get in the game. So there's going to be different more clearly defined different tiers of miners in the public market. I also think that this phenomenon is maybe the wrong word, but this kind of dynamic that's going on with public Bitcoin miners helps private miners as well, because private investors see upside beyond just, they don't think, okay, I'm just investing in this private company that equity, may be very illiquid for many years to come. They see that this is private investors, both debt and equity, see this as an evolution of this industry now. So they see more upside with their private investments, which makes running a private miner a bit more easier, gives you a sense of that access to capital without necessarily taking the full step to go public.
Mm-hmm. And so, Todd, obviously you have a private mining company, right? So how does what Ben and what Jason is saying feed into how you think about scaling GAM?
Yeah, I mean, I think there's still a lot of meat on the bone for the private miners. I don't think it's like a go public or go home kind of game here. Mm-hmm. I do think that a lot of the current publicly traded miners had significant trade-offs when they did, go on that path to become public. Like if you look at a lot of the cap tables there, I mean, they're primarily owned by people who don't work there. So I think if you are a private miner and you're very creative and kind of stay true to Bitcoin mining's economics, you can still do incredibly well and potentially will be even better positioned going into the future.
So one of the things that was brought up, Ben and Jason, on what you were saying is really public mining, obviously there's decks that we see, right, of people who are like, hey, I have X amount of hash rate now and I'm going to have X amount in the future. And I think that this has been a consistent theme that I know all of us has really grinded most of our gears, right? It's really difficult to tell the story of being a miner, right? Never mind when you have to tell the story when you're comparing it to people who have I don't want to call it smoke and mirror, but sometimes it feels like it could be a little smoke and mirroring. So how do we think about valuing public miners? Or just generally mining? How do you guys think through that as companies within mining?
I think this industry is so new that the investing community is trying to figure that out themselves. And I think the one metric they've grasped an understanding of is hash rate and forward-looking hash rate. It seems to me as if a lot of companies are being traded somewhat driven around what their year-end 2022 hash rate looks like. And I say that very generally. There's other factors that are playing into this here, but very generally, investors are looking at this, potential leverage bet they can make with a Bitcoin mining investment. So what is that company going to look like in terms of hash rate, I guess now, a year from now? But that's, of course, not the whole story. We all work for mining companies here. There's a lot more to entering into an order with Bitmain, MicroBT, et cetera. There's a lot of work that goes into getting that miner plugged in, having that underlying infrastructure running to actually be mining and keeping that hash rate sustained, day over day. So, in my opinion, the market is going to learn more and more about Bitcoin mining as it remains involved and interested. And I think one of the emerging traits that will become more important over the next 1 to 2 quarters will be the execution capability, and I think that'll stand out a lot amongst different miners.
Yep, 100%. I mean, I think right now, you see these big order announcements, and they obviously have an impact, but come 6 months, a year out, once you see who's actually kept up with being able to plug them in, and I think everybody here in this podcast knows it'll be a totally different story. So.
Yeah, I think this is a indication of how early this market is in terms of institutional investor adoption. We had the Bitcoin rally starting in November, December last year, it seems like a lot of people were just desperate to get any exposure that they could, and not really understanding the space, they grasped on to probably what was the easiest metric that they could, and that was contracted hash rate. I think as we go on over time, people are going to get more sophisticated in their analysis and, are going to develop a little bit more comprehensive KPIs in terms of how you evaluate all these different miners, because there's not very much that, we differentiate ourselves on. I mean, you've got how much hash rate you have now, how much hash rate you have coming, how much Bitcoin you have on balance sheet right now, what's your cost for the hash rate, that you've purchased, and what's your cost to operate that, and how good of an operator you are in terms of your online and your uptime. It's not a whole lot of variables. It's not like we're Pepsi Cola and you've got all these different sub businesses and different categories and different consumer groups. This is something where the various valuation differentials really can exist sustainably in the long term. I think as people get to understand this industry and they really start to understand these economics, I think there's going to be a lot more a level playing field across the different competitors. And really, it's just going to take some time for people to understand, that contracted hash rate is one thing, but really, your ROI on your hash rate and your new miner purchases is probably your key figure. If you pay too much on your hardware, you can't get your money back if you're buying at the peak and the market turns against you. And so this is something that we saw in the last wave of publicly traded miners back in 2018. There was a slew of new miners coming onto the market because they could raise capital quickly and easily. But they didn't last more than a couple of months. And it's really because they bought at really high levels and weren't able to operate, that equipment on a cost-effective basis and achieve an ROI. So this is going to be a key thing going forward. And I think we're really just on the starting point of this. Really just a few analysts are covering the space right now, and most of them have only been doing it, for a matter of months.
Yeah, I think you'll see more differentiation as well as time goes on. So for example, like with Riot becoming more vertically integrated, Windstone, the electrical provider you acquired a week or two ago, like that's considerable differentiation, on our side being off grid, having more quick access to more expandable megawatts, I think is a point of differentiation as well, which is totally different than somebody who, sure, maybe they own a power plant, but they're only ever going to generate 50 megawatts from that power plant. So I think we'll see a lot more differentiation as well.
Yeah, miners have certainly gotten very gritty. And I think that's been something that has been consistent since mining really started, right? We're seeing like a rise of a lot of people trying to home mine too, right? Which is totally a different structure and ball game than what we're talking about here. But it has been an interesting year in mining. Obviously, we've all been in mining for a little bit now, and it seems like there was a point in time when Ben and I were in China together in 2018, where it didn't really seem like a lot of people were talking about mining. And that has totally changed since I'd say like the halving. The conversation has totally shifted and people actually want to talk about Bitcoin mining. But the one thing that I agree that we all touched on that is left out is really that operational risk and execution risk, right? It's kind of like what press releases don't tell us, right, in the background. So what do you guys really, obviously like you have to share information on all of your companies, both private and public. Like, what do you think is like really distinguishing and traits that people should look for as they're looking at these different companies?
I mean, I would look at the announcement to hashrate online, kind of tracking how that's tracking. I think you'll already start seeing some very stark differences without calling anybody out specifically who's not on this call, for what it's worth. And like really just the different management teams, how are they going to get beyond whatever their footprint is? I mean, obviously Texas is quite a big spot. What happens once that plays out? Like how much more scale is there beyond what's currently planned? So what happens next?
I think the deployments is a big one, because people are so focused on that contracted hash rate, but the hash rate is not worth anything unless it's plugged in and turned online. So, having a deployment schedule and meeting that deployment schedule, I think is really key. I don't think that's something that the market is paying attention to at all. They're so focused on that end of 2022 number that they're ignoring all of the interim. Mining is a very strong opportunity cost. If you don't have your miner plugged in today, you will never, ever get that revenue back. There's just no way that you can recover it. So people are not understanding that there's an opportunity cost to not have your miner plugged in, to have it sitting on the floor. And this is, I think, what's separating out a lot of the operational strength of the various miners in the field.
Yeah, I mean, I'll just echo the same that Todd and Ben has said. I think investors, the community should be looking at what were previous announcements, how are those playing out? Okay, understand everyone has difficulties. There's been a multiple of issues that affect probably all of us. Global shipping logistics has become very challenging, particularly around the holiday season. But that doesn't always explain such dramatic differences in deployment schedules. Something I think is helping investors see this, which I think is so cool, is how many YouTube channels cover Bitcoin miners now. Like I every day I subscribe to all the channels. I'm looking forward to all the videos that get posted, and it's so cool to see this kind of new source of information covering the stocks that's distinct from maybe sell side analysts that you have independent people doing their own analysis. Maybe they're a little biased depending on how their portfolio is weighted, but they're out there covering these companies, looking at announcements, comparing results, etc. I think that's been very cool.
One thing when it comes to operational risk, right, is, Jason, obviously what you talked about with shipping and logistics, right? Like that is like a big thing that's kind of out of the control of anything that we can really realistically control. But another one is ASICs, right? So nearly 1 million ASICs are on order by publicly trading mining companies to be delivered through year-end 2023. So if we're making a conservative assumption on the cost per terahash, we're talking about like $5 billion being spent on ASIC machines. Now that opens up two questions for me. The first one is, can we depend on ASIC manufacturers to deliver on time and how we think that we're going to get them delivered? So we'll start there, and then I'll ask my next question afterwards. I don't want to overwhelm. Todd, when you think about ASIC procurement, how does that affect how you build a GAM, and have you ran into any issues?
Yeah, I mean, so we're considerably smaller than these other guys. So like our supply chain issues are around, like different kinds of infrastructure. So for example, we build our data centers on trailers right now, and it's really hard to get trailers because everybody's buying trailers to move stuff around the country. So we're at the point now where we found someone who can build them custom for us, and we're just talking the base of the trailer, and then we build everything else on top of that. So we're seeing those issues left and right. We're having to source some parts for containers from, like 3 or 4 different supply houses for the same part to get the quantities we need. So we're at a point now where we're trying to get ahead of the miner deliveries. And our plan right now is essentially to just have, let's call it 10 to 20 megawatts of rack space ready to go, so that we're changing the problem from like building rack space quick enough to we have it ready to go once the machines arrive and we ship them out.
Yeah, it's a delicate balance, right? Between like making sure you have everything up and running to then having a site up and running without ASICs.
Yeah, exactly. And then, so I mean, right now, I'll be candid, we're enjoying the delays from some of the mining manufacturers because it's making it more easy for us to land stuff on site without much down, that gap in between. So
that's interesting.
I think just touching up on that, this is kind of a new development, Amanda, like back when we were mining in 2016 and that sort of thing, you were always buying spot miners. It wasn't ever a situation where you're doing a monthly purchase 12 months in advance. I mean, this is a completely new development that happened with the silicon shortage last year. And it's really the semiconductor foundries that have pushed that out, from going to like a 3-month lead time to a 12-month lead time. And a lot of these contracts, are huge scale. You would have never had an agreement before where people are buying 10,000, 50,000, 100,000 miners, back in 2016. And now this seems to be the growth story and the demand. Realistically speaking, there's no practical way to deploy 100,000 miners within 3 months. And so if you are targeting those kind of figures, like most of the public companies are, you really actually do need those longer lead times. And I think, a lot of reliance is put on a single manufacturer, which is a risk. You can't have everybody relying on a single company, Bitmain, for every single order. I think the market's destined for some massive disruption so as long as we have increasing Bitcoin price next year. And I think that's going to really, put a lot of pressure on the manufacturers to deliver and keep up with these new emerging players that we're probably going to see emerge as this bull run continues, to 100K, 200K, et cetera.
Yeah, this phenomenon with monthly contracts far out has certainly been an interesting development. I believe we entered into an order in April of this year where the final shipment month was October 2022. So I mean, like that's so far out orders. But to your point, Ben, having this more predictable schedule definitely helps with the supporting logistical development. It'd be so much more challenging if we were, you're out there just going spot and okay, we need to go get 15,000 miners this month, or whatever number, because the infrastructure is now ready. Having this kind of ability to plan, I think makes things, alleviates some amount of risk. Of course, it introduces new risk as well. There is some forward price risk that you encounter around here, changes in technology, changes in, the marketplace as a whole, but does help with planning.
Yeah, the risk. Oh, go ahead. Sorry.
I was just going to say, I think this is a sign of the evolution of the industry. We're becoming a lot more like the other data center industry, where you are talking about equipment purchases and new builds 2-3 years out. This is the evolution of the industry. I think it's destined to happen, and I think it's kind of necessary for Bitcoin to scale the network and continue to secure it, at the levels that it needs to be secured. It does bring a little bit more, I think, professionalism into the industry to have those longer lead times, and for people to be consistently hitting regularly announced milestones, as opposed to, hey, we randomly purchased 1,000 miners. Hey, we randomly purchased, 5,000 miners. So I think this is a necessary evolution. It does introduce new risks, but I don't really see any way around it.
So how do you guys model out, expected returns for machines if you don't know the final price of those machines, because they could change, because the technology can change and the price of those machines can change? That's a little bit of a tongue-in-cheek question coming from me, because I also have to answer that question regularly, but it's tough, right? Like, you have this whole idea of what you think is going to happen, and then it's like, oh, new node, new price of machines, even though you've forward paid for, these machines already. How do you guys get around that risk?
Very dynamic modeling. Yeah, I mean, yeah, you like everything in life, there's so much uncertainty and risk. We can make the best approximation, the best estimates of what this is going to look like, and then we can update as those assumptions and information changes over time. I think it's good to, when you're modeling and planning for this, you are, thinking about different variability and outcomes. Hey, what happens if price is going up 20%? What happens if price is going down 20%? What happens if this? I think there's a whole multitude of scenarios that it's important to analyze. So in the aggregate, you come up with an average case solution that you're planning around. But that's just a long way, Amanda, of saying it's very challenging.
But then how do we explain that to investors too, right? Like, people who are like now trying to want to look into Bitcoin mining to like get their hands dirty. And then you say, hey, yeah, mining is a great thing to invest in. And they say, well, tell me my ROIs. And we're like, well, it kind of depends on a few things, right? Which is reasonable for most businesses, but it feels like it's a little bit more difficult to explain when you have to explain hash rate price, Bitcoin hardware issues, supply chain constraints. Like, how do we get investors comfortable with this, both, Todd, from your perspective as a private company and then as a public company?
Well, I mean, how I get myself comfortable with it is I'm just comfortable with the chaos in general. But I have a more like paper napkin math version of this. So for example, if someone's telling me today, just to keep the math simple, that I can buy $50 a terahash out in December 2022, and then we know hash rate is going to double based on public announcements between now and then, it's like, okay, so that's like me paying today $100 a terahash. If I could plug that machine in within 14 days today, would I do it? I'm not going to like it, but I'd probably still do it if I had the space. Back to like the hotel analogy. If you don't sell the bed, it's gone forever. And also knowing that there is some congestion in terms of new chip allocations, like that's a bet I would make right away today, as much as I would not enjoy it. Other than that, I think we're all operating on a bit of like speculation, and we're all depending upon the maturity of this market overall to carry us with it. And I think there's a lot of more people are, I think, starting to see some things that we all saw probably 6-7 years ago happen today in their personal lives. So I think that weighs into everything, especially, as you're saying with investors and looking at the space. Like you can kind of read the tea leaves at this point. So what's going on?
We take a very pragmatic approach to it. We model everything based on a USD per terahash figure. And then, if you're looking at your cost per hardware on a USD per terahash, and you're looking at the revenue on a USD per terahash, what you can do is you can come up with a high and low scenario. Hey, based on network growth assumptions of this is how many miners are being manufactured every single month. And we forecast this out, 6 and 12 months. This is what the price range can happen with Bitcoin, up, down, $10,000 increments. And we can go from 50,000 down to 10, and we can go from 50,000 up to 100. What we get is a range of USD per terahash scenarios that can happen with the market over the next 12 months. And with that, we can also extrapolate what our ROI is going to be in these various conditions. And so what we do as a miner, instead of hedging against our downside with puts and call options and that sort of thing, we want to maintain that maximum upside, but we also want to protect ourselves on the downside by positioning our company to be a low-cost producer. And even in a negative, bearish scenario, we're still going to achieve high ROIs and fast ROIs. And so what we say is like, okay, based on the price for our hardware now and what we expect the market can do, even in the worst case scenarios, what's our worst ROI? And as long as we can plan for our worst ROI, then we're okay in any scenario better than that. And I think that's the way that you have to approach it. You can't go in there with the assumption, like a lot of people do, that, hey, this is the economics today. These economics carry forward for the next 12, 15 months. That is, it's mathematically impossible for the economics to stay consistent. And so they'll operate in those bands, and you have to position yourself as a miner on that lower end of that band, so that in the worst case scenarios, you're still covered. It's the people who are, targeting, hey, all of our math is based on today, and they're not anticipating that things can change for the negative over the next 6-12 months. And this is changing, it's becoming more complex because the lead times are getting longer, but it's also getting more complex too, because they're, like groups like yours, Amanda, Galaxy has all these financing options. And so that actually changes the picture a lot too. As long as you are able to maintain those payments, that's going to radically affect how you're looking at those ROI pictures, right? Because for a lot of these miners, it's now becoming a free cash flow. Are we able to afford these miners? We're going to borrow against them. We're going to maintain those cash payments, and then we're going to keep scaling that, which does kind of compound those problems. But really, I think you have to operate in a band and position yourself, always being hedged against the downside by being a low-cost operator.
Yeah, I think that's so key. I think all of us on this call, we're into Bitcoin mining because we believe in Bitcoin and we believe in the future of Bitcoin mining. Like Ben said, you don't want to give up that upside. So, looking at hedging is, not very, very appealing. You want to just focus on protecting your downside for to make sure you have a good ROI in all types of market environments. And, the data is out there. You can look at old financial statements from public companies, look at what their cost of production was or is, and look at what that did to financial results during, the tough times of, late 2018 for mining. This is why having a low cost of production is so important. It's easy to not care about it now when margins are 80% plus, and 4 cents a kilowatt hour seems nothing compared to 6 cents a kilowatt hour. Hey, it's all great, but these type of market conditions don't sustain forever. You want to be positioned so you're always driving your business forward no matter what.
the traditional finance derivative guys are floored right now from this conversation, right? So, that brings me to my second question when it comes to ASICs, right? So this is a massive market for people like Galaxy to create financial solutions for Bitcoin miners. So, when we think about treasury management, right? And also, just like how we get access to capital beyond, just being a public miner. How do you guys think about that for each one of your companies?
Treasury management, I think, is a really interesting and new field. If you looked at the public miners as of a couple of years ago, there was actually very little Bitcoin being held on the balance sheet. Most of the operators were selling everything that they were mining. And so this wasn't really about that long-term upside and what that Bitcoin asset can do for you as a company and the opportunities that it can provide to you in terms of borrowing against it and it being a strategic credit facility. Really, it was just seen as a quick cash flow. I think the industry's really changed as of this year. It seems like every single public miner now is going very, very heavy on the HODL strategy. I don't know of a single, maybe with the exception of, I think, Iris Energy, I think they're selling all or most of the Bitcoin that they mined. But other than them, this is a long-term HODL. And I think the asset is really, really interesting because of groups like Galaxy. This is another way for us to raise capital at really, really cost-effective means, fast, flexibly, and again, at a low cost. And so if you're looking at how do you raise money for your company, you have a couple of assets, and borrowing against your equipment is one of them. Borrowing against your Bitcoin is another one, or using the capital markets is another one. And obviously there's going to be a balanced approach is the most desirable of the three. You don't want to be over leveraged in terms of your debt, but that Bitcoin as a strategic facility is really good. And if you can borrow against the Bitcoin to pay for your operating expense as opposed to selling your Bitcoin, then you preserve all that upside for the minimum cost of capital that it takes to borrow against it. So I think this is a real interesting thing. We haven't seen how this is all going to play out yet, but I think most of the miners are anticipating that Bitcoin is going to reach, 6 figures sometime next year and beyond. And so while you have 80, 90% gross mining margins now, if you're not selling until after 6 figures, it's well worth the cost of capital to borrow against it. And so this is real changing dynamic that we haven't seen play out before. But it seems like every miner is going down this path because it's one of the most valuable things that you can have. And if companies like MicroStrategy, can issue huge amounts of debt to acquire huge amounts of Bitcoin on their balance sheet is a strategic asset. Surely Bitcoin miners should consider this as a strategy as well, especially since we have such a lower cost of acquisition. We're producing Bitcoin for well under $10,000 when the market value is 40, 50, it doesn't matter. The other public companies who are acquiring it can only acquire prevailing market prices. And so this becomes a real strategic advantage for us, and nobody can increase their profit margins. Like us, it's hard to imagine a steel producer holding on to just huge amounts of steel because there's a huge cost to do so. They can't borrow against their steel, that's sitting there in inventory. But we as public miners do have a lot of strategic advantage there. It's no cost essentially to store it long term. And there's lots of things that we can do it for the benefit of our company.
Yeah, it's been great to see the emerging, you could say, tool set that miners have to raise capital to avoid having to sell Bitcoin. I think it becomes particularly a bit easier right now during these very strong markets. There's an excess amount of, not excess, but there's a readily amount of capital available for financing. In a bear market, won't necessarily be that case for all operators. It will become a lot more of a squeeze and tougher to hold on to that Bitcoin. But the competition around the space has been driving down the rates for Bitcoin-backed loans, driving back the LTV ratio. Like this is great for the industry. This is a kind of a great tool set. Just talking about specifically Riot, one of the things we're trying to do to help enable us to hold on to as much Bitcoin as possible is utilize the hosting segment of our business to pay those self-mining expenses. We are not there right now, by any means, but that's something that we think about, and it's a goal we think about of, trying to create this little well-oiled machine where one hand is paying for the other hand, and we can try to retain as much Bitcoin as possible. But yeah, they utilizing these tools certainly pay for themselves. Like Ben stated, if you're bullish on Bitcoin, you're thinking about a 6-figure Bitcoin price in the future, it is worth it to retain as much as possible. And that, would make up for that debt financing cost or any type of financing cost.
I mean, we've been leveraging our Bitcoin now, I think since early 2019 to fund growth. And, now we're in a period where we're valuing growth higher than holding that Bitcoin on our balance sheet. I kind of cringe to admit that, but this is a temporary period where we expect we'll be phasing out of that, into next year. So
it's really hard to think about selling a single Bitcoin that you mine, especially at the rates that we're all mining it at, right? That's like the tough part. I think Treasury management will be a really interesting thing for miners over the next 2 years. I think that the ones that get it right will be the ones that will be able to hold on to that Bitcoin longer term and last.
Before we switch, sorry, Amanda, one thing I wanted to add is kind of the contrasting feedback that I get from the public on this topic. Mm-hmm. Retail investors, institutional investors as well, but the retail investors love the idea of holding on to as much Bitcoin as possible because they are aligned with the company's mission of the future value of Bitcoin. There are an increasing number of institutions that think the exact opposite. I talked to an investor the other week, and he was like, I don't get it, man. Why can't you just sell all the Bitcoin you mine? Just act like a normal business, sell the thing that you make. And I'm like, well, there's a lot of upside here, or we perceive there's a lot of upside here. We believe in the future, and we want to be positioned to participate in that. So, just wanted to add, it's interesting to see the conflicting, feedback on this from investors.
Yeah, and that investor must be relatively new to Bitcoin, because if he was around for like the last bear market, he would have seen the miners who made it versus the ones who didn't were the ones that helped.
Yeah.
Pretty fascinating. What do you think are the major drawbacks to being either private or public?
Well, there's certainly an increased cost, both in terms of just expenses you have from audit, legal, finance, but also the cost of time management has to put into doing these things. Going through audits, preparing financial statements. That these are, especially for an SEC issuer, these are really big undertakings, and that a lot of resources has to come in from the company to stay current and to be accurate and be complete with these filings. I think the other downside is, I wouldn't go as far to call this a downside, because I think being public overall has great advantages. But, as compared to a private company, we don't have the same, we have to disclose all of our material contracts. We have to disclose, kind of what's going on. And that makes a company more investable. That's why I didn't want to call that a downside. The fact that a shareholder can see what's going on, they have a full, complete picture of the company, that inspires confidence, gives them the information they need to make an investment decision. But, if you were trying to operate in stealth, if you had some sort of big idea you wanted to keep, secret for competitive reasons, still possible as a public company, but creates a lot more challenges. So in some regards, sometimes envy a company like Todd's, where they're kind of able to operate and execute on their plans, and maybe not have to give up anything to competitors who you can maybe learn from them.
I think we definitely have a lot of extra things that we have to do as a public miner that you would never have to do as a private miner. Certainly there's a lot more audits, a lot more overhead, a lot more, keeping up with the forms and everything else. But I think at the end of the day, the ability to raise capital at a lower cost and raise the money from strategic investors by being a public company is well worth going through all those different challenges. In the past, I've done a number of different smaller Bitcoin ventures, and raising money from investors tends to be a bit of a challenge, because you've got to prove and you've got to verify your numbers. Having an auditor, like we have a Big Four auditor, that provides a lot of confidence in our numbers to investors when they say, okay, your hash rate is actually your hash rate, your numbers are actually your numbers. And that's not really something that's so easy if you're not doing those different things. So I think it's an advantage, but it does limit you a little bit on the flexibility side. You know, we have to go through things. As a result of that, we have to go through things a little bit slower. We have to be a little bit more prudent in our risk management. We've got to balance everything a little bit more evenly. Whereas, you know, I'm a mega Bitcoin bull and a mega Bitcoin maximalist. You know, sometimes you just want to go, but, you know, you have to take a more balanced approach. And I think a private company can do that a little bit more flexibly, but, you know, they could be doing that at a higher cost of capital.
Yeah, I mean, I guess I'd just say that, like, you know, we can still, as a private company, we can still do those things that are painful, but that give investors comfort, like an audit. Like we just started one this week that we're putting ourselves through so that we're, you know, so we have that process in place. And, you know, to Jason's point, like, I don't envy those additional costs you guys have to, you know, to operate in the public markets, because at the end of the day, that still gets factored into what your costs are. So I think that's a minor advantage that, you know, theoretically offsets some of those cost of capital points you made, Ben. I think as well, though, like the, you know, 2018 to 2022, for sure, far easier to raise money as a publicly traded miner. That I don't think that's necessarily going to hold true into the future, though. I think there's a million people who want exposure to this kind of an asset. And, you know, maybe we don't have the same rails to get them there. But there's still a lot of people out there.
Yo, my fellow Bitcoin lovers, have I got something specifically curated for you. The Deep Dive is Bitcoin Magazine's premium markets intelligence newsletter. This isn't some pay group selling buy and sell signals. No, this is a premium Bitcoin analysis led by Dylan LeClaire and his team of analysts. They break down in an easily digestible way what is happening on chain, in the derivatives markets, and in the greater macro backdrop context for Bitcoin. This newsletter turns volatility into a joke. So hit up members.bitcoinmagazine.com and use promo code podcast for 30% off the deep dive. That's members.bitcoinmagazine.com, promo code podcast for 30% off. Divorce your paid group and learn why Bitcoin is the ultimate asset by Dylan and his team. My fellow plebs, the Bitcoin conference is back. Bitcoin 2022, April 6th through the 9th, is the ultimate pilgrimage for the Bitcoin ecosystem. The Bitcoin conference is the biggest event in all of Bitcoin and cryptocurrencies. We're leveling up and making this bigger and better than ever. I'm talking straight to the moon with the 4-day-long festival in the heart of Miami at the Miami Beach Convention Center. This has something for everyone. Whether you're a high-powered Bitcoin entrepreneur, a core developer, or a Bitcoin newbie, Bitcoin 2022 is the ultimate place for you to be with your people and celebrate and learn about the Bitcoin culture. So make sure to go to b.tc/conference to lock in your official tickets and use promo code Satoshi for 10% off. You want more off? Pay in Bitcoin and you'll receive $100 off general admission and $1,000 off Whale Pass. Those are stackable. So go to b.tc/conference and attend the best conference in Bitcoin history.
So one thing that's kind of interesting that also came up in the last podcast was that we're not accounting for the job creation that is happening around mining beyond just people plugging in machines, right? So now we have big four auditors, like Ben was saying, that he uses, that has to understand mining in order to audit it, right? And so I think the tentacles of Bitcoin mining have started to like really spread into different parts and of, you know, multiple different industries. And I think that's kind of a really fascinating thing to think of. Like people on our ops team have to understand why we're making certain decisions to be able to tell the auditor why we're making certain decisions. And I think that it's really interesting to think about the amount of people now that are working in Bitcoin mining, you know, as it is today versus like 3 years ago. It's really fascinating.
Yeah. Sorry, go ahead.
No, go ahead. Go ahead.
I was just saying, yeah, I mean, it's fascinating. Like, you know, being up on oil fields in North Dakota, you know, you've got an electrician who's coming to, you know, because he's permitted to operate in the state, he's coming to do our final hookups. We're essentially setting up a power grid off the grid every time we do this. Now, instead of him just having the oil companies as a customer, he's got us. So, I mean, he's theoretically doubled his work for every site. if every site ends up with a Bitcoin miner there. You take truckers up there. We have to use specific trucking companies to bring these things who are qualified on the oil fields. You take, and I know you guys see this as well, just like your standard electrician, who's got a little bit of an edge and is into some stuff that's a little further out there, like the stuff we deal with in terms of the intensity. And you now transform, this like career path to something totally different for them. You take fabricators. I mean, it's throughout, most industries that can get their hands dirty, so it's pretty cool.
I think this is one of the key parts about the pendulum swinging back to North America that is often misunderstood. We have a situation in the U.S. where the U.S. went heavily, industrialized throughout the 20th century, but then they exported everything and outsourced it to third world countries. And especially where we are in Quebec, we're running all on hydroelectric power that was built primarily by heavy industry, 50, 60, 70 years ago. This was companies like the Iron Ore Company of Canada, companies like Rio Tinto, gold mining companies, logging companies. They were setting up remote industrial operations in the province of Quebec. And the only way to power those economically and sustainably was with this, construction of a renewable energy dam, like a hydroelectric dam. There was no way that they were going to bring in the diesel or bring in, the coal or anything like that and make that work cost effectively. And so as they scaled back, or as they shut down or outsourced or built up a more efficient smelter somewhere else, these hydroelectric dams remained there. These communities remained there, but the jobs just disappeared. And nobody's ever wanted to reinvest in these remote communities. They've sat, kind of dormant and economically depressed for decades on end, because a lot of the time it would be only one corporation that is providing the vast majority of the jobs. And it's probably the only reason why that town exists in the first place. And so once that industry left, there was a big glut. And now Bitcoin miners are finally saying, hey, these areas are actually worth it for us to invest in, because we don't care about the remote costs. The logistics don't really matter to us as much. It's not like we're importing a bunch of raw materials and exporting a bunch of finished goods. We're trying to take advantage of the lowest cost energy, and the lowest cost energy exists in the place where nobody else wants it. And so when we come into these remote communities, we're creating jobs that, have not existed. Like in the province of Quebec, we've taken over a number of industrial facilities, a former hockey stick factory being one of them. It sat dormant for 30 years. Nobody wanted to invest in that infrastructure, and we did. And we brought a number of jobs there, which was a huge economic boon to the community. And I think that's a very, very important part of the story that people need to understand. We're providing good, high-paying jobs, especially in these remote communities that desperately need the economic activity.
Yeah. Just to echo Ben there, the high-paying point, without a doubt. We definitely end up paying these people more than they're making elsewhere, because the economics provide for that. So
this is a great story that doesn't get told enough in Bitcoin mining. It's something that we should all work on to get out there more. There's this misconception that Bitcoin mining means just computers packed up, no, workforce needed to make that happen. Could not be further from the truth. There is so much work that goes into building these operations and maintaining those operations. So, Ben mentioned smelting plants that get shut down. The Whinstone facility is located off-site, where it was a former Alcoa aluminum smelting plant that got shut down in 2008, and that decimated that community. It was an entire city built around that plant. And like Ben said, miners are agnostic to the location that they come in. Wherever we can get that cheap power, we will go. And in Rockdale, Texas, where Whinstone is located, we have created approximately 160 jobs at that site, and that's just employees, not including contractors, to build that site and execute on the expansion plans we have going on. And that might not sound like a huge number, but when you're talking about isolated communities that have a population of 5,000 or so, that becomes very meaningful, not even to mention the indirect benefits that go to that community from the indirect jobs that are needed for these new people that are coming to the communities, for the tax benefits that come, for the things that I know we all do with our companies to give back to the communities that we operate in. Bitcoin miners have a very meaningful social impact. I know a lot of people like to talk about ESG, and a lot of the focus is around, energy and energy mix, but there's still an S in there. And I think Bitcoin miners are exceptional at that component, allying with the community and giving back to their community.
Yeah, Jason, 160 jobs in one location is just really also like front office. You guys have people that work, in all different places that support like your business. So that's
160. That's a lot of that are builders. We have management, we have administrative staff on that site, but there's people that are building, the foremen that supervise their teams underneath them, and then you're right. We have the the whole Riot corporate office that runs Riot at a corporate level, and with this acquisition of ESS Metron the other week, adding electrical engineering, manufacturing in-house, that's kind of added even more to the employee count. So I think I think building things, I forgot who said this recently, but I think it's a great point. Building things is how you get more Bitcoin, and you need people to build things.
Mm-hmm. Nicely put. So entering into another year, right, of Bitcoin mining, do we have any, I hate predictions, but do we have any themes that we think we're going to see next year?
You say memes?
Themes, but we'll see lots of memes.
What are they going to be the emerging 2022 memes?
I think the public miner thing is going to be a continuing big story. I think the monetization of energy is going to be a really, really big one. We see this everywhere we go, is electric companies and energy companies looking to the Bitcoin market as an alternative place for them to sell their energy. It doesn't matter what energy market you're looking at, unless you're looking at a place like New York City or a remote island like St. Lucia or something like that. It's probably the best market for you to sell your energy to, is the Bitcoin mining market. And so all of these groups are starting to look at this. And this is also something that's starting to change, the renewable energy picture a lot. If we can come in there and we can provide that response demand, that's a really big deal. People never really had an idea that this was a problem that was solvable. Traditional data centers have to run with massive diesel generators as backup. And it doesn't matter if you're looking at, Google, Apple, Facebook, whoever, they may be powered by renewable energy, but the second that energy goes out, they crank up the diesel generators because, if for 1 second you can't access Twitter, people are going to lose their minds. But the Bitcoin mining thing is coming in there with that demand responsive grid. And this is solving a problem that nobody ever thought was doable. I think that will be a really, really big theme next year. And it really is the big driving force on the ESG. We're monetizing energy that otherwise can't be used or otherwise wouldn't be wanted. And that's going to be having huge knock-on effects, economically throughout everybody. It's through the utility, it's through the grid, it's through better prices for the consumers, it's through a more balanced load through the consumers. I think those will be the big driving stories, and possibly the emergence of some new mining manufacturers potentially in North America, because this is a thing that we're seeing happening as the China mining ban continues to take hold. And I think there's still a lot of mining still taking place in China that hasn't been cracked down yet. Probably will be later next year at some point, and for probably many more years to come. But one of the problems with that, or one of the things that we'll see with that, is also the transition of hash rate to North America, and probably the transition of manufacturers to North America, because as the companies in North America become more sophisticated, become publicly traded, become audited, investors become more in tune, they're also going to want to have contracts with American manufacturers. And I think this is going to be a huge prevailing theme as we have the next Bitcoin bull market next year.
Yeah, I mean, once again, on point with everything Ben said there. And I think, what can I say? It's just a lot of things that I agree with. I'd also think that because of a combination of both, the difficulty to get on the miners, to get, orders of miners, which in turn drives up the price of miners, I think there's going to be growing work and innovation around making the most of, maximizing the output, the performance of the miners that you do have. So obviously I'm thinking about things like immersion cooling, thinking about third-party firmware to unlock greater output. Immersion cooling, I think, is becoming more feasible now. In the past, it was certainly cost prohibitive. Didn't really ever see it on a big scale, but I think through innovation and competition in that space, that type of infrastructure is going to become more available and more in use in Bitcoin mining, and then that helps enable kind of these other operational benefits you can get from running third-party firmware on your machines, doing whatever to improve the efficiency and output of your fleet of hardware. So. Yeah, definitely excited to see what happens there. People motivated from a lack of supply, motivated from too high of prices, and looking how to make their operations more efficient with their own innovation.
Well, there's one thing I won't agree with. I think you guys overestimate the public's ability to really get down into the nuts and bolts of what we do and why it's good. So I think we're going to continue to get clobbered over the head in the media anyway for being, the horrible people or whatever it is. I've seen no evidence yet that like they're going to overcome some of those same talking points we see every bad article published about Bitcoin. So I think that's going to continue to be a struggle. I think in general, one thing we might not see, and maybe this is too optimistic, but at-home mining, it's like, well, how big of an impact can it really have? And it's like, well, I mean, you get enough people orange pilled on Bitcoin who want to heat their garage for, $200 a month and make some Bitcoin off that. Would 1 million people do that? 2 million people do that? Maybe that's too many, but like, I wouldn't underestimate home-based mining. And then of course, I got to talk my own book here. I think we'll see more mobile miners, someone like myself who will back a truck up to a trailer and bring it wherever the cheapest energy is. And to your point, Jason, with immersion, I think that's what will also enable folks like myself to get into West Texas, where cooling can be challenging in a dense space, with immersion helping us overcome that.
Todd, I am going to disagree with you a little bit and use your company as an example. Here you guys are using a bunch of flared gas and doing flare gas mitigation on some of your projects, and I think this is one of the key things that is really going to drive home the environmental angle. For the first time ever, we actually have a non-government subsidy that is providing a direct incentive to reduce carbon emissions. And we have never, ever seen such a thing. There is no greater technology on the planet today that exists that is better at reducing emissions than Bitcoin mining. And it's a direct economic incentive that incentivizes, almost every energy producer out there to reduce their emissions without any government subsidy. As we get a greater and greater pressure on the environmental side of things, especially on the CO2 and the emission side, Bitcoin is going to be at the forefront of the solution to address this. And there is a way for people to increase, oil production, increase nat gas, and also reduce emissions. And, we can't have the gasification of all coal plants in North America and Europe without increasing supplies of natural gas, increasing natural gas producing facilities, increasing amounts of natural gas pipelines. Currently, the story is we need to shut down new pipelines. We can't allow new construction, but that's simply not an economically viable story. And so as we see pressure, on inflation and commodities, especially on the nat gas side of things, I think Bitcoin is going to come in there to help ease those pressures. And it's going to be a big, big thing next year. And as legislators, regulators, and politicians and bureaucrats start to figure this out, and corporate CEOs figure this out, this is going to be a huge game changer for the industry. This is the only technology that exists that provides that incentive. And without it, it's kind of crazy to think what we could be emitting if they wanted to ban Bitcoin mining. So I think that is, and companies like yours are doing a great job at that. And so I think that's going to be a big driving force next year.
Cool. Do you mind sending me a headshot? And if I put it into our latest deck, that'd be great. Thanks.
I think that there's going to be a lot more M&A activity in mining. That's my take for next year. a little bit less philosophical than you guys, but I do think that there'll be some natural like synergies between larger companies and smaller companies in the space. So that's what I'm keeping my eyes on.
Cool.
I think that makes sense too. There's a lot of opportunities out there in the space, and if you want to grow quickly, M&A is the way to do that. I mean, we just acquired a site in Washington and enabled us to get a foothold in the United States, and that's the way we like to grow is, acquire something small and grow it out to its full potential. And so I think we're going to see a lot of that stuff happening.
Yep. Well, guys, thank you so much for your time. Happy holidays, and this will be posted on Bitcoin Mag. So
Awesome.
Great.
Awesome.
That was fun.
That was
Thanks,
awesome.
guys, and thanks, Bitcoin Mag.
Bye,
Okay.
guys.
Bye, Meg. Bye.